Hey there, savvy investors and curious minds. Welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're putting a very specific company under the microscope, WLDS, or Wearable Devices Limited. It's a name that has recently popped up on our proprietary hard-to-borrow screener, and its current setup warrants a closer look. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, who is Wearable Devices Limited, or WLDS? Sure, WLDS logo/company info. This company operates in the cutting-edge technology and consumer electronics sector. They are developing a non-invasive neural input interface, essentially allowing you to control digital devices using subtle touchless finger movements. Think about controlling your smartwatch or other electronics just by gesturing in the air. Their modular development kits are at the forefront of this innovation. As of now, WLDS has a relatively small market cap of $7 million. Looking at recent price action, WLDS saw a modest plus 1.75% gain today, but it's been a bit of a roller coaster, down 18.99% over the last 5 days, yet still up an impressive 72.62% over the last 30 days. Today's trading volume was 422,400 shares, which is quite low compared to its 30-day average volume of 3,173,006 shares, putting its relative volume at just 0.1x average. Share volume chart. What is cost to borrow and why it matters? One of the most critical metrics we track for short squeeze potential is the cost to borrow, or CTB. In simple terms, when you short a stock, you borrow shares from someone else, sell them, and hope to buy them back later at a lower price to profit. The cost to borrow is the annualized interest fee you pay to borrow those shares. It's an incredibly important indicator because a very high CTB signals intense demand to short a stock and a limited supply of shares available to borrow. When borrower fees start to exceed 100%, or even several 100% annually, it tells you that short sellers are paying a significant premium for their bearish bets. Why this stock is hard to borrow right now. And this brings us to WLDS. Why is it on our radar? Because its cost to borrow fee is an astounding 839.2% annualized. Highlight CTB number. That number is absolutely massive and tells us that borrowing shares of Wearable Devices Limited right now is incredibly expensive. This extreme fee suggests very high demand from short sellers coupled with an incredibly tight supply of shares to lend out. Adding to this scarcity, WLDS has an estimated float of just 1.9 million shares. A small float means fewer shares are available for trading, and even fewer for lending. Currently, the number of shares available to borrow is unknown, which often means supply is extremely low or completely dried up. Our internal composite squeeze score for WLDS sits at 49.8 out of 100, indicating a moderate, but not extreme, potential for squeeze activity. Now, it's crucial to remember that a high cost to borrow does not guarantee a short squeeze. It can also signify that short sellers have very strong conviction that the stock will decline, and they are willing to pay a premium to maintain their positions. Squeeze mechanics explained. For those new to short squeezes, let's break down the mechanics. A short squeeze occurs when a heavily shorted stock rapidly increases in price, forcing short sellers to buy back shares to limit their losses. Imagine short sellers betting against WLDS. If positive news or strong buying pressure causes the price to rise, these short sellers, especially those paying an 839.2% CTB, start feeling the heat. To avoid potentially unlimited losses, they must buy back the shares they borrowed. This buying activity, known as covering, creates even more demand for the stock, driving the price higher and trapping more short sellers in a vicious cycle, leading to rapid and explosive price surge. Dilution risk check. Before getting too excited, we always perform a dilution risk check. Dilution happens when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. New shares can also provide liquidity for short sellers to cover their positions, potentially negating any upward pressure from a squeeze thesis. The good news for WLDS is that we found no recent dilutive SEC filings such as -1s, -3s, or 424BS in the last 90 days. This means there haven't been any recent public offerings that would add new shares to the market and dilute existing shareholders. Recent reverse split watch. Another important factor for WLDS is its recent reverse stock split. Wearable Devices Limited executed a 1-for-3 reverse split just 55 days ago, on June 22nd. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For WLDS, this effectively cut its float, or the number of publicly traded shares, which can further intensify the scarcity of shares for shorting. Historically, many microcap stocks that undergo reverse splits tend to see renewed volatility or a price pop within about a month after the event. While WLDS is now slightly outside the typical 1-month window, the reverse split is a significant factor in understanding its current low float and potential for price swings. It's a pattern we observe, not a guarantee, but it certainly adds to the dynamic of WLDS. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for if you're tracking WLDS? First, keep a very close eye on volume. Today's volume was only 0.1x its 30-day average. A significant, sustained increase in trading volume would be a crucial indicator that interest and buying pressure are building. Total volume chart again. Second, continue to monitor the borrow supply. A further reduction or confirmation that shares remain extremely scarce would signal even more pressure on shorts. Third, watch for any news or catalysts from Wearable Devices Limited. A new product launch, a key partnership, or any significant development in their modular technology could be the spark needed. Finally, observe the price action, especially after its recent 5-day dip and its impressive 30-day run. Look for sustained upward momentum. WLDS presents a fascinating case study in the world of hard-to-borrow stocks. With an incredibly high cost to borrow, a tiny float, and the context of a recent reverse split, it certainly fits the profile of a stock to watch. However, as always, exercise extreme caution. High CTB means high risk, and short squeezes are never guaranteed. Always conduct your own thorough research. If you found this deep dive into Wearable Devices Limited insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments below what other stocks you'd like us to analyze next. Until then, happy trading and stay vigilant.